Hello everyone, my name is Connor, and today I'm going to be showing you how I make a couple trades, how I look at charts technically, and how to set my exit, the indicators I'm using, my predictions, and the risk profit graphs that come with it. Alright, so this chart that I have in front of me is JPM. I like the look of it. It's a pretty thickly traded stock. There's a lot of volume, so you know it's liquid. You can get in and out pretty easily. So you can see an obvious channel here coming down. And right now it looks off like it's bouncing off this area, this peak right here. I have a feeling prices are going to keep going down in the next week or so, all the way down to 115 and possibly 110. So yeah, we're going to go take a look at the options chain and do a little analysis on what we think. I have one set up here already. It's a put diagonal, which is a bearish strategy. Another reason I want to be bearish on this from the technicals is also if you look at the financial ETF, it's bouncing off a pretty good resistance level right now of about 35, and you can see it goes all the way across. So I think this can bounce off. This trend for the short term should be going down. We'll go back to JPM. Another reason for looking at this options chain, they have this nice little section here where it shows your current implied volatility percentile and your current historical volatility percentile. The historical volatility percentile is higher, so that's indicating this is where it should be, but the implied volatility percentile is right now what the options chain is expecting from the expected future prices and the patterns. So I think over time this will come back to its historical expectancy. And typically when you're expecting implied volatility rank to go up, you want to be taking, I like to do diagonals because it actually shifts the break even of both the current value option. So we'll see this. We'll go to this little settings button. This is volatility here. So you're going to see I'm going to increase it by like 10%, and these break evens are going to shift over. Oh, sorry, shift that way, making us more in the money. So we are positive volatility on this. As volatility goes up, we're becoming more in the money, making money, which I really like. Alright, so there's this diagonal trade. I'm going to show you how I set it up. So what I did was I go to the options chain. I went to about 120. Chose a diagonal. So for this type of diagonal that I use, I want the front month to be my target. So I got a target about 110 on this for September 9th. That's about 21 days, as you can see here. It's capital T's, days till expiration. And in the back month, I'm going to have this use a strike price of 120. I'm only going to risk about, I don't want to risk around $500. $750 is okay. So right now the cost of this option is $319. So I'm going to change my quantity or contracts to 2. Press enter. This is just a simulated trade, so I'm going to check out the risk profile. And this is what I've created. So we'll reset this volatility back to where it should be, 0. So the front month expires on September 9th. And up here, this gray area is showing a 1 standard deviation range of where the price could finish by September 9th. You can adjust this stuff, the lesser the date, or for it to reach a price in a smaller amount of time, the expectancy of one deviation is going to be smaller. But by the expiration date, it has a chance of finishing in the money up here. It also could be down here. However, as you can see, the loss to profit ratio potential is significantly better. Over here, it's about, says in the bottom corner here, what the purple line is, current value, and the green line at expiration value. So right here, we're getting a $800 current value. And down here, we're getting a $485 current value. That's almost a 2-to-1 profit to loss ratio. So I like that. Yes, the initial price is starting a little out of the money. But if volatility goes our way, down here, that could shift in, helping our position. Unfortunately, this is a long position where we're taking in a debit, so time decay affects this position negatively, especially if we're already out of the money. So down here, I can change the current date. So as the days pass, you're seeing it shift, shift, shift. The purple line's getting tighter, tighter, tighter. And at this point, the current value of this option is getting less and less and less. That is the time decay theta component from the Black-Scholes formula. So we'll put this back to the original start date I had, which was today, August 19th. And that's pretty much it. Once I set the trade, just right click on this simulated down here. You go create duplicate, and you can enter the trade. Confirm and send. This window will pop up. It show how much buying power you're using. About 638. I said I didn't want to do more than 750. I'm practicing with a $25,000 account, and I don't like to risk more than 3% per trade. 3% is 750, so this is within my acceptable limits. So you just click send. Bing, bang, boom. And then in terms of setting an exit, I would like to get a bit more than my max loss, which is, look down here at the green, which is 636. So it would be nice to get 636, 700 on this. I think it has a good chance of getting there in 22 days. We'll look back at the technical chart. This is a nice little technical indicator here. It's the ATR 50. So things could move about $3 a day. You never know. But I think there's a good chance that if this pattern and momentum continues, it can keep chipping down, and within a week, 2 weeks, it'll be at 110 and hit this support level, hopefully. If not, then getting closer to the expiration date, if I feel the price has gone pretty far out of the money, I'll just take the loss. And how I pair some of these trades is I'll take another trade, also a diagonal, but it'll be a call. So this will be reversed. And let's say the market heads in the opposite direction of what I'm thinking, then hopefully that other trade will be able to profit. I can take a good profit from it, and it will be more than the loss on this trade. In a way, hedging. One trade is making more than the other one is losing, so the net difference is positive. That's what you hope. All right, so that's all the explanation for today. Thank you for listening, and have a great day.